Welcome to our channel. Today we will be discussing on Customs Act, a few case studies for Customs Act 1962 in continuation to our previous videos on valuation rules and the types of duty. Okay, the second question that we are taking, we'll just go through the question. So first one is cost up to the place of export and loading charges. So they have not given the FOB value. We have to arrive at the FOB value and then arrive at the assessable value as well. So FOB value is cost up to export, port of exporter. So, what is FOB value? Free on board value. Anything, all the costs incurred except for insurance and freight. That is your FOB value. So, cost up to the port of exporter. Then loading charges, 25,000. These are given in yen. So, we need to convert. So, this will be in yen. What is the value in rupees? Value in rupees is this into 0.71 that is given in the question, rate of exchange. So I'm getting the value in rupees. So on this, so this is my FOB value. Is there anything else? We'll just go through that. Design charges will not be included in our cost. And commission paid, yes, commission paid will be added. Commission paid to the exporter. Any commission other than buying commission is part of your FOB value. So commission paid 1,25,000 rupees. This has to be added to, now this is our FOB value. Okay. Now, how to arrive at the CIF value? CIF value is your assessable value, which is your FOB value. Insurance and freight has to be added. So, freight charges is given. It is 1 lakh yen. So, I have to convert, if freight charges, I have to convert 1 lakh into 0.71, which will be in rupees, because now my FOB value I have converted in rupees, and hence the freight also I have to convert in rupees. And then commission paid. Landing charges at the place of importation will not be considered, because any cost after the import happens will not form part of our assessable value. Insurance. Insurance is not ascertainable. So what we will do, we will take FOB value into 1.125%. Now that is your insurance. Lightage charges. Lightage charges is part, it is incidental to import, and hence we have to add it. Lightage charges, bar charges, demurrage charges, these are all charges which are incidental, which have expenses that is incurred at the port to bring to unload the goods and bring it to the shore. Okay, so these charges will be part of our CIF value or the assessable value. Now we have arrived at the assessable value. So on this basic customs duty, this is 10% of our, then surcharge, that is social welfare surcharge. Surcharge, if it's given in the question or not, we need to take 10% of the basic customs duty. Then integrated tax. So integrated tax will be calculated on assessable value plus all the customs duty. So this will be value for IGST calculation, and on this we have to add 18%. This is our IGST. And hence the total duty will be IGST plus basic customs duty and surcharge. This is our total duty. Total duty payable. This case study is about calculation of anti-dumping duty as well. So we will approach the case study and see the solution. Assessable value for levying basic customs duty. So they have already given us the assessable value in the question. It is 631 250 rupees. So again, no issues with conversion of rate. Quantity imported is 250 kilos. Basic customs duty is 10% and IGST is 18%. So basic duty is 10% of our assessable value, and we have surcharge. Surcharge is 10% of this. So the total value that is being arrived is 7,06,087. Now, as per the notification, anti-dumping duty will be equal to the difference between the cost of commodity calculated at $50 per kg and exchange rate being 70. So what we have arrived now is our export price. Okay. So this is the price at which the product has come into India post all the taxes at normal rates. This will be the rate at which it will come into India. And on this we will add IGST. But what is the normal value? Normal value is 50 rupees per kg. Total quantity imported is 250 kgs. So 50 into 250 into 70, which is the rate of exchange. So this is your normal value. So what is the difference? We have a difference. The difference will be our anti-dumping duty that has to be applied. So anti-dumping duty is the difference between the normal value and the export price. So this is the anti-dumping duty. Now how IGST will be calculated? IGST will be calculated on the assessable value plus all the customs duty. All of them, like anti-dumping duty, if there is countervailing duty, all the duties put together. So IGST will be on assessable value plus basic custom duty plus surcharge plus anti-dumping duty. On this, we will take 18%. This will be our IGST. So what is the total duty payable here? It is the sum total of all the duties: anti-dumping duty, customs duty, surcharge, IGST. So this will be our total duty payable. I hope the video was of some insight to you on the case studies. Stay tuned for more such videos, and thank you and all the best for your exams.